Welcome to another edition of Inside the Economy. I'm Brian Gieman. Thanks for joining me. Happy Memorial Day and unofficial start to summer. On today's topics, we're going to review tariffs and the European Union, the interest rate story, as well as a little bit of sharing of debt. And lastly, we'll cover stock market performance around the world. On the economic front, this is not an economy in distress. Highlighted numbers to update here is the current CPI figures, the Consumer Price Index, headline at 2.3, core at 2.8, lower than earlier parts of this year and certainly meaningful lower than May of last year. Continued good news on the inflation front. The biggest updates and where we're seeing the most moves is certainly in the crude markets, looking at about $61 and change per barrel. That is near the lows of the year, certainly substantially lower than where a barrel of oil was May of 2024. So continued movement on the oil and gas front. The other highlighted figures here would be movement within the 10-year and 30-year Treasury bonds. We've seen those tick up to closer to the peak of the year. We will expand a little further on what's taking place in longer dated bonds and the 30-year in particular. Mortgages also ticked a bit higher, but continue to hover in that high 6% range. And again, not a lot of distress or anxiety that we're seeing in terms of the economic backdrop. So things continue to look pretty good from an employment as well as an inflation perspective here for the U.S. Let's jump into the tariff and European Union conversation in particular. So this last month, we had a record, about $22 billion of customs duties and excise taxes were collected within the month of May. That compares to about $16.5 billion in the month of April. So certainly a substantial tick higher when it comes to import duties, and we're seeing direct impact on these numbers via the Treasury Department as a result of tariff policies. Now, why is this taking place? First and foremost, we have the 10% baseline tariff across the board. We also have the extra 25% steel and aluminum tariff, as well as the 25% tariff on autos. So despite the 90-day pause that we've seen with large trading partners out there, that is the main reason why we're continuing to see larger moves up. And as we'll talk about in just a moment, the European Union is a big portion of this. This slide is going to pay a little bit of homage to Larry's last slide from the previous video, which highlighted how the European Union, as opposed to China or Southeast Asia, is actually our largest trading partner. And here we can see it front and center. We import roughly $600 billion or so from the European Union. We export about $370 billion, the red and blue figures. What I think is really important about this chart is when we break this down into percentage of GDP figures, that EU-US relationship is actually about 5% of overall GDP. That's compared to 2.2% when it comes to the China figures that are fourth on this list. So one reason why we've really seen the EU and the US in the headlines and those trade conversations continuing to evolve, especially even just over this last holiday weekend as well. As we dive a little bit deeper into what are we importing from the European Union, a lot of key items on this particular page, but I would highlight pharmaceutical in particular. About 125 billion of that figure is from large pharmaceutical companies based out of the European Union. We've also seen quite a few large US-based pharmaceutical companies set up shop in Ireland in particular for tax purposes. And that's why we see quite a bit of that coming across the pond to the U.S. Believe it or not, Ireland actually exported more goods to the U.S. than both Italy and France in 2024. Outside of the pharmaceutical industry, it continues to be a auto and a cars and trucks story here. Roughly about $45 billion of auto imports and different types of machinery were a part of the imports here from the EU. On the other side of the coin, what is the U.S. exporting to the European Union? Here, it's really an oil, gas, autos, and airplanes story in particular. The U.S. shipped about $30 billion worth of airplanes and airplane parts to the European Union last year. We also do see a little bit of the oil and gas numbers here highlighted by crude and petroleum gas within the figures. Last but not least, about $12 billion worth of autos were shipped to the EU. What's interesting about this fact is it's actually European brands, BMW, Mercedes, all American made and in American factories that are being shipped across the pond in terms of the exports. Now we see a little bit of a further breakdown of goods and services with the EU and the US trade. What I think is of a particular interest on this chart is, first and foremost, a significant step up from 21 into 2022 and 2023. Is that the world normalizing post-pandemic, and are we continuing to see more reliance on the Eurozone and the US from a trade perspective? Also of particular significance is the EU actually imports more services. Now, these can be difficult to track. Business consulting, banking, these often don't go through ports or customs, so it can be a difficult barometer ultimately to measure. On the other side, no big surprise, as we talked about in the slides before, the EU is exporting more goods to the US in terms of those pharmaceutical manufacturing components as well as the autos that we had discussed. So fascinating to see the balance here, and just a little bit of a further breakdown on what we're seeing with the EU and the US and why it's been in the headlines recently. Let's switch gears. Let's talk about interest rates and what's happening within various parts of the fixed income market. Here we have the US 30-year, the long-term bond, at its decade highs, also right back to the peak of 2025. Of particular interest here, we did see about a week or so ago, Moody's, one of the large credit rating agencies, did downgrade its view of U.S. sovereign debt. It joined the other large credit rating agencies, which had also downgraded U.S. debt over the last handful of years. Is that having some impact on what's taking place within this chart and long-term interest rates moving higher? Are we seeing a little bit of maybe the bond market pushback to some of the policies coming out of Washington, the big, beautiful bill in its infancy stages? A lot to be yet determined on that front, but just fascinating to continue to see those longer dated bonds and various parts of the fixed income world move higher. What does that mean for banks? This slide is going to highlight and depict what we are seeing in terms of losses on the books of small and regional banks, often associated with lending on commercial real estate. Now, this particular slide is going to show treasuries, mortgage-backed bonds. What I think is really interesting here, the blue segments labeled held to maturity. That means that these smaller banks and regional banks are not going to sell these securities. They're going to hold them to maturity, continue to collect that coupon, and hope to be made whole on their principal once that term ultimately ends. Now, this is a little bit of homage to a handful of years ago when interest rates went up substantially. We saw larger losses within the bond and the fixed income world, probably highlighted by the collapse of Silicon Valley Bank and some of those other regional players. We haven't seen that, so I think the overall takeaway on this slide is, yes, there's maybe still a little bit of stress in the system, but these smaller financial institutions are still operating as is, despite some of the losses that we're seeing on the books here. Switching gears here, we're going to talk a little bit about short-term interest rates now and what the Federal Reserve is doing and what they're expected to do by market participants. A chart going back to 2004, so about 20 years worth of data here. Most notably on the right side, we can see the substantial move up from zero interest rates to north of 5%. That's the blue line, which has since then settled at about 4.5%. Now, if we compare and contrast that to the red line, which is what the market or the futures market is essentially anticipating, it is a lower interest rate story here in the US. Market anticipates rates to be lower by maybe approximately 1%, somewhere in the 3.5% versus the current 4.5% number. Will this ultimately come to fruition? We'll wait and see. It certainly looks like the Federal Reserve is not incentivized at this time to lower interest rates at the June meeting. Perhaps that's a later summer or a fall story that we'll continue to see evolve. As we zoom out a little further and we look at 5 of the 10 major G10 central banks. So on the right side of this page, we'll notice that there's 4 of these banks that are all somewhat clustered together in positive territory. The Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Canada all above that 2% level. And as we can see with the dots as well, indicating the forecast, it is pretty widely anticipated that interest rates from these large central banks will fall over the next year or so. So that plays exactly into what we had just seen when we looked at the US one slide ago, but it's a pretty major theme as we look kind of across the globe. So what is the exception on this chart? It is ultimately the Bank of Japan, and here we see a much different story. Down at the bottom, it's actually anticipated that those interest rates will move up slightly. And we can see as well from going back to 2015, just a much different story for the Japanese economy. Interest rates were zero, if not negative, for a good portion of the last 10 years or so. So we continue to see the Bank of Japan trying to normalize their interest rates and tie that in with the economic activity. On the major indices, we've seen the markets bounce back after the April rout, and as highlighted by Larry's last video, markets have turned over just a little bit here over the last couple of weeks. Overall, we would say that the markets are somewhat fairly valued at this point, and we're sitting at levels pretty close to where we were late last summer / early fall when viewing this versus the 2024 figures. What's working well continues to be an international story. Here we can see the Hang Seng Hong Kong index, as well as the Korean index and the Stock 600 Europe, all in positive territory year to date. Let's call these high single-digit, low double-digit returns through the end of May. On the other side of the ledger, the U.S. markets, the S&P 500 as well as the NASDAQ, both in slightly negative territory. And then we also see portions of the international mainland China, the CSI 300, as well as Japanese markets, the Nikkei 225 down at the bottom, all in negative territory. So just a fascinating year where we're seeing international markets. I'd highlight particularly portions of Europe that are doing quite well versus their U.S. counterparts. Last but not least, one fun slide to end on today. Here we're going to see the overall spend between 4 different countries around the world, or groups of countries in the case of the European Union, on research and development. So when we look at this slide, let's ultimately think technology, robotics, artificial intelligence, satellites, a lot of the infrastructure spend that we've continued to see specifically out of corporate America. Now, it is still the U.S. leading this charge. We've put approaching $900 billion to work within these categories going back to 2007. Of particular interest is China's spend. Pretty dramatic upward movement over the last almost 20 years now at this point. So despite some of what we've talked about from an interest rate perspective, or perhaps a deficit perspective within the U.S., we continue to see companies spending, and there's a lot of research and development money pouring into new technology. As always, please send your questions to info@shjwealthadvisors.com. Thanks for joining me. We'll see you next time.